Okay, let's dive right into this explainer. If you really think about it, the economy is essentially just a massive, incredibly complex game. And like literally any game out there, there are rules. But the catch here? These rules are entirely hidden from plain sight, and we are all forced to play whether we know them or not. So today, we're going to completely decode those rules. Picture this. You've just had a grueling month. Maybe you've been slaving away flipping burgers at your local McDonald's. You're exhausted, lying in bed, and ping, you get that highly anticipated email, $2,000. But then you check your actual bank account, it only gets $1,456. You scroll down the pay stub, and there they are. Federal tax, state tax, Social Security, Medicare. It's like this modern ritual of giving away a massive chunk of your hard-earned money to invisible forces. And the kicker, they completely expect you to say thank you. So where does it all actually go? Well, that brings us to our roadmap for today. We're going to cover the cost of civilization, the banking illusion, interest and invisible thieves, the credit scorecard, the illusion of money, and finally, winning the wealth game. Let's start with Section 1, the cost of civilization, or the price of society. Let's figure out exactly where that missing chunk of your paycheck actually vanished to. Basically, there are several main types of taxes hitting your wallet every single day. Income tax takes a bite out of what you make. Sales tax hits the money you spend. Capital gains tax? Well, that hits the money your investments made while you were sound asleep. Then there's Social Security, which is basically the government forcing you to save for retirement right now just so they can pay it back to you way later. And Medicare is a health insurance tax supporting older folks and those with serious health issues. Honestly, filing all these is like playing this incredibly stressful guessing game where the government totally knows what you owe, makes you guess, and if you're wrong, you're cooked. But hey, it's not all bad. At its core, taxes are really just the cost of civilization. They fund the roads, the schools, they ensure your favorite taco truck is rat-free, and generally speaking, countries with higher tax rates just tend to have a higher quality of life all around. Moving right along to Section 2, the banking illusion. Where is your money? Okay, we really need to challenge a massive assumption we all make right after we hand our cash over to a bank teller. When you deposit your cash, the expectation is that your money is just sitting there in a massive steel vault somewhere, right? Maybe being strictly guarded by a fire-breathing dragon. But the reality? It's something called fractional reserve banking. Banks are really just middlemen. They're matchmakers. When you deposit $1,000, the bank instantly takes 900 of it and lends it out to someone who wants to buy, I don't know, a jet ski. The whole system only works because they keep just a tiny fraction of the money on hand, betting that everyone won't show up at the exact same time to withdraw their cash. Unless it's 2008, of course, and the whole system crumbles. They simply make their profit by lending your money out at a higher interest rate than they actually pay you. Now, don't panic. Despite this whole fractional system thing, you do have a safety net. $250,000. In the US, the government assures you that your deposits are insured up to this exact amount per person. So honestly, no matter what happens with that guy's jet ski loan, your money, up to $250K, is completely, absolutely safe. Plus, let's be real, it is a lot safer than just keeping cash stuffed in a shoebox under your bed. All right, Section 3, Interest and Invisible Thieves. The double-edged sword. Think of interest simply as money's way of charging rent to exist in someone else's hands. There are basically two types. Simple interest is like saying, hey, here's a flat fee, thanks for playing. But compound interest, and this brilliantly illustrates the difference. Compound interest means every dollar I gave you now has clones, and those clones also want rent. If you owe 20% interest on a credit card and miss a payment, your interest starts earning interest. Suddenly, a missed payment for a $12 late-night burrito turns into a $50 regret. It's the slow burn that turns tiny mistakes into absolute financial fires. But on the flip side, if you are the one investing at a 7% compound annual rate, it is literally a cheat code. Your money just duplicates itself. 100 becomes 200, then 400, and one day you wake up old, rich, and maybe a little smug about it. But wait, there is another invisible thief out there. Have you ever wondered why your favorite bag of chips is suddenly half empty and like 30% more expensive than last time? The answer is inflation. It's the slow, quiet erosion of your money's value. Your $5 bill is still technically $5, sure, but it buys way less gas and fewer instant noodles. So what actually causes it? Well, often it's simply too much money chasing too few goods. Imagine 2,000 people all wanting a $500 TV, but the store only has 1,000 TVs in stock. The store owner sees that crazy demand and instantly raises the price to $800. A little inflation, like maybe 2%, is totally normal. But when it spikes, your savings die and your wages really start to lag behind. And sometimes the government has to fight that inflation by raising interest rates, which cools down everyone's spending and leads to the economic cycle. Boom, peak, bust, and reset. That bust and reset phase? Yeah, that's a recession. It's when the economy officially drops for at least 2 quarters. Think of the economy as a massive party. In the boom phase, the drinks are flowing, everyone's dancing, having a great time, but eventually reality hits, someone checks their bank account, and suddenly the DJ just starts playing sad, lo-fi beats about corporate downsizing. It's painful, for sure. Jobs vanish and people start saving instead of spending. But remember, recessions aren't forever. They are just temporary resets. Eventually the spending returns and the whole cycle just restarts. Section 4, the credit scorecard, the ultimate trust metric. We are talking about that shadowy algorithm that constantly judges your past, totally remembers that late credit card payment you made back in college, and completely dictates your financial future. It spits out a number from 300 to 850. Now, this 3-digit number isn't about how wealthy you are, it's entirely about trust. Lenders are basically asking, if I give this person money, will they actually bother to pay me back? If you score below 580, you are essentially a walking red flag to lenders. You'll either get rejected outright or hit with a soul-crushing 27% interest rate. But if you score over 750, oh, you are sparkling with adult credibility. It's pretty much your golden ticket to buying a house or a car on genuinely excellent terms. So, how is that magic score actually calculated? Well, it's a mix of payment history, which, by the way, is the absolute biggest factor, credit utilization, the age of your credit, your mix of different loans, and any new credit applications. Honestly, think of your credit score like a pet dog. Ignore it, miss your required payments, and it just poops all over your life. Take care of it, feed it on time, and it helps you buy a house. And here is a totally wild fact. You can have absolutely zero debt, be perfectly responsible with your cash, and still have a trashed credit score simply because you have zero credit history. The game is absolutely rigged, yes, but if you learn these rules, you can rig it right back. Let's move to Section 5, the illusion of money. What exactly is value? So, the crucial point is, this takes a slightly philosophical turn, because we really need to understand what value actually is and confront the wild fact that currency itself is just a social construct. Seriously, look at a dollar bill right next to a stick. Objectively speaking, there is no real legitimacy difference between them. The only reason that piece of paper can buy you lunch and the stick cannot is because we as an entire society have collectively agreed that the dollar bill is worth something. Humans develop money simply to make trading and organizing society easier. It's not real in a physical sense. If the government prints too much, inflation just makes it monopoly money. If they print too little, the whole economy grinds to a halt. The whole shebang runs entirely on a shared belief and mutual trust. And because money is based purely on belief, we arrive at a very simple truth. Provide value equals earn money. Imagine a normal, everyday rock versus a shiny yellow rock. That shiny yellow rock is gold. It's not inherently more useful, but humans place a way higher value on it simply because it's rare. People like Steve Jobs or brands like Gucci earn massive amounts of money for the exact same reason. Millions of people perceived massive value in an iPhone or the prestige of a designer handbag and willingly traded their socially constructed dollars for it. Figure out how to create value that other people perceive, and you will make money. It's that simple. Finally, Section 6, winning the wealth game, the cheat code. Okay, so we've decoded the invisible rules, the inflation traps, and the illusions. Now, let's talk about the cheat code to rig those rules firmly back in your favor. To win the game, your money literally has to stop sitting around and start working. You have to transition from trading your time for money to trading your money for more money. Stocks let you buy tiny ownership slices of a real company. Bonds are basically you playing the bank, loaning money to governments or companies in exchange for interest. Funds are collections of these, so you don't have to play financial games one by one. And real estate, well, that's property you hope someone else pays to live in. And yes, investing definitely involves risk. Markets are going to go up and they're going to go down. But the real danger? The real danger isn't a temporary market drop. It is never investing at all, and just letting that silent thief, inflation, quietly steal your future value. And to make all those investments actually work, you need the absolute ultimate secret ingredient: time. It is, without a doubt, the greatest force in wealth building. Almost everyone starts with a lot of it, but it's definitely not unlimited. You know, most wealthy people did not win the lottery. They didn't beat the system. They just used the system. They invested consistently, they diversified their risk, and honestly, this is the hardest part, they were just patient. They gave compound growth 30 whole years to do its thing. A little money, given enough time, becomes an absolute mountain of wealth.
So what does this all mean? We end with this one question. Will you let interest be your worst enemy or your absolute best unpaid employee? You now see the hidden mechanics. You know taxes are the price of society. You know banks just lend your deposits right back out. You see exactly how inflation erodes value, and you understand the immense, life-changing power of time and compound growth. The rules of the financial game are simply no longer a secret to you. You hold the power and the knowledge to start building your own wealth today. The choice of who collects the rent on your money, well, that's entirely up to you.